Hello, dear students. Let us understand about leverage in this session. So, leverage it is a tool to uplift the business using several different tools such as banks, financial institutions, friends, neighbors, relatives, etc. So, whenever we are in need of fund, we can raise funds from all different sources. So, using that sources where we can easily use that fund and we can just apply that funds in our business. So obviously our business will reach to a higher level to improve. So this concept is basically called as leverage. So business has both different kinds of funds such as owners funds as well as outsiders funds. So it is actually difficult to run the business only using owners funds. That is called as unlevered form. So where if you are taking help from all different sources, that is actually called as levered. So unlevered, only bonus funds. So levered form is something that mixture of combination of all different sources. So it includes owners, include banks, it includes financial institutions. So many sources, shares, so will be included there in this outsiders funds. Okay, so that it is easy for to easily lift the business to a higher level. So in this leverage, we have different types such as classifications, operating leverage, financial leverage, and combined leverage. So for this session, let us specifically deal with financial leverage. The actual format of this financial leverage or the general leverage is, sales. From sales, the aim is to find out the profit. So from sales, will be reducing the variable cost, which gives a term called as contribution. And from this contribution, again, we need to use two different costs, such as fixed cost. Another one is, operating fixed cost. Another one is non-operating fixed cost. So that we can easily calculate earnings before interest and taxes. And the other one is, if we reduce non-operating fixed cost, the final thing that we'll be getting is earnings before tax, where we can also call this as profit before tax. So this financial leverage, it specifically deals with financial fixed cost. That is why it is actually termed as financial leverage. Where operating leverage, that it actually deals with operating fixed cost. Okay, so the name is called as operating leverage. So there are two types of fixed cost, right? One is operating, another one is non-operating. Okay? Non-operating is also called as financial fixed cost. So this financial leverage, it has, it deals with the relationship of earnings before interest and taxes, that is EBIT and EBT. So these two things, its relationship gives, what is the meaning of this financial leverage. So obviously formula will be for this financial leverage, EBIT divided by EBT. Okay. So here we have a problem. Let me dictate the problem now. A company has a choice of the following three financial plans. You are required to calculate the financial leverage in each case and interpret. Okay. So, project X or company X, we can consider company X, Y, Z. So, and its particulars details is what given. Using these particulars, we need to identify financial leverage. Okay. In all the three cases, that is X company and Y and in all different plans, right? X, Y, and Z. So equity capital is mentioned here and debt data is given here and EBIT. Directly we have the EBIT. Okay. So we need not to calculate, the procedure for EBIT, sales minus variable cost minus, contribute, all these things. So directly EBIT value is given here. So it is easy for us to do the calculation. So, so EBIT is also called as operating profit. So that data is given here as 400 for all different financial plans. And one more data is given here, that is interest at 10%. Okay. So where we need to use this 10% in all different financial plans, X, Y, and Z. So how to work on this? Let me see. So this is the solution for the question given above. Now, EBIT data is given here. See here, 400 for all different financial plans. So we just wrote that data, 400 for all. So EBIT, again, here in this problem, we have EBIT. In case if you are not having EBIT, you have to calculate EBIT. Again, what to do? Sales will be there. Okay. Variable cost data will be there. So what we need to do? Sales minus variable cost, which gives us contribution minus fixed cost. Yes, this fixed cost will be getting the answer as EBIT, earnings before interest and taxes. Okay. So see here. So EBIT is directly given here. And from this EBIT, if we reduce interest at 10% on debt, see the question? 10% on debt in all of the three cases. So how to calculate that? 2000 into 10%. So 2000 is our debt, right? See the question here? 2000 is our debt. For this 2000 into 10%, we need to calculate for X plan, and 3000 into 10%, 1000 into 10%. See here? So if we do the calculation, we'll be getting 200 for X, 300 for Y, and 100 for Z. So three different financial plans. Okay. So by doing this, we'll be getting EBT. So EBT, that is earnings before tax. What is earnings before tax? 200, 100, and 300. Okay. So EBIT is directly given in our question. EBT, we calculated EBT, that is profit before tax. We can also say. So that is 200, 100, and 300. So what is our formula for financial leverage? EBIT divided by EBT. Okay, EBIT divided by EBT. So that is the formula for financial leverage. So we have EBIT. See here for X financial plan, EBIT is 400, EBT is 200. So 400 divided by 200. For the next one, 400 divided by 100. For Z plan, 400 divided by 300. So we are getting the answer here as 2 times for X, 4 times for Y, and Z financial plan, it is 1.33 times. So what it actually indicates, if sales increases by 1 time, so EBT, it is going to increase by 2 times. If we follow the first plan, that is X plan. And similarly for the rest of the plans also. If sales increases by 1 time, then, EBT, profit increases by 4 times. Okay. So for the next one, profit increases by 1.33 times. So this is what the financial leverage answers if we follow 3 different financial plans. Thank you all.